coming off what has historically been our worst 2 week period in the markets over the last a series of years. Um, but we went up. And why? And what does that mean? Let's take a look at that today on the Market Brief. Hey, everybody. Welcome to today's Market Brief. My name is Chuck Fulkerson with Mainstage Capital Group at TradersArmy.com. Hope you guys are all having an absolutely amazing trading day. And I want to talk a little bit about the concept of why markets do what they do. And when we look at the history of the markets over the last 10 years or so, historically, some of the worst weeks in the markets are the last 2 weeks of February, the first 2 weeks of March. They're historically bad weeks in the market with a lot of bearish movement. But this year was different, right? This year was different. And I think it's important to talk about why. So let's first look at some of the history that I'm talking about. So let me slide over to the charts here real quick. What you can see here, this chart is a seasonality chart. And what you can see is that we are looking at a 10-year chart of the S&P. Now, what is the 10 years? Well, the 10 years, I didn't mean to zoom in on that. The 10 years is this black line represents the average movement over the last 10 years. And what it shows is over the last 10 years that we've averaged a gain of a little under 10%. But during that period, you can see that we have historically had a peak right here on, oddly enough, Valentine's Day, a day that's for lovers. Historically, that is a peak in the market, followed by a decline until about March the 20th. And so historically, the market goes from being up about 2% to down about 2%. So it's about a 4% swing on average over the last 10 years in the S&P. Let's look at over the last 5 years. So over the last 5 years, the peak is actually here, which that day would be February 14th. And the bottom is also February 21st. So about the same, but it's from a 3.25% bullish market to about a 4% bearish market. So a 7% pullback during this 2 week span over the last 5 years on average. But what about this year? Well, looking at this year and the same period of time, we on February the 14th, so roughly the same day, which would be right here, there was our February 14th. And notice that at that point, we were up about 5.7%. The markets right now are up 8.18%, and we've not yet made it to that part of March. And so I think that if I were a betting man, which I'm not, I just want to play the most likely scenario. My guess is that we would continue to trade higher over this next run for a while. And so my question is why? Right? Why have we seen these markets rally up in the way that they have over the past few weeks? Now, we did see, let me put this back to just a basic chart. If I move this to a daily, we did see that the S&P had a big drop down from here to here. This February 12th to February 13th, we had a big gap down, and that was on the FOMC announcement that we were going to slow down the tapering of the rates, and so the market kind of reacted a little bit here. But other than that, it's essentially been a straight up market in our S&P since February the 13th. We got that gap down, and we've done nothing but go up ever since. Now, today's candle, a little bit of a reversal pattern is forming for price to come back to more of a retail price point. And we very well may do that, but ultimately we've maintained a bullish environment. So let's talk about a few things. First of all, fundamentally, are the markets telling us that we should fundamentally be bullish? Are our inflation numbers any better? Not really. Is it cheaper when you go to the grocery store? Not really. Are you saving money at the pump? Not really. So we're spending more. Is our national debt getting better? That's funny, right? My point is that fundamentally, why are we going up? Well, what about from a what about rationally, right? Well, it's an election year. So an election year, the market has a better chance of going up because maybe the people that are in charge want it to go up. Okay. Well, what about just the price of stocks and earnings continue to go up? Here's what I want to give you. Here's the bet. Are you guys ready for this? Here's the secret. I don't care. I don't care. It doesn't matter to me why we continue to go up. What matters to me is that we do. And until I am proven otherwise, if I look at the S&P 500 here on a weekly chart, if you look at this, are we overextended? Absolutely. Have we gone up too far, too fast, and we are way overextended? You bet yourself we are. Matter of fact, if I count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 candles, 16 of them have been green and 2 have been red. We have not had a streak like this in a lot of years, right? Matter of fact, we've got to go back. Let me take this back to a 10-year historical chart. Historically, over the past 10 years, if I just look at the angle of this move from here to here, right? That's a 72-degree climb on that angle. Coming out of COVID was 55 degrees. This move here was about 65 degrees. This last little run up here was about 68 degrees. So my point is that when we look at the sheer move up and the speed, can it continue? Yes. Yes. The answer is yes, until it stops. And how do I know when it stops? Well, you don't really know when it's going to stop, but that's really where it's important to start to look at technicals and understand where do we find swing highs and swing lows to give us some cues. So right now, what's my line in the sand? Well, right now I'm paying attention to this area right here as the most important line because this is my last area of old resistance and new support. Beyond that, I'm looking at this area right here. Those are two key levels that I'm paying attention to. And when I look at those on a weekly chart, we can see that those actually wrap their lines around this one red candlestick. Now, I will tell you, I keep waiting for price to pull back into here. To me, this area here becomes an excellent buying opportunity should the market pull back. The problem is if you continue to wait for market pullbacks in a bull market, you may never get in. So when's the right time to get in? Well, the right time to get in, if you feel like we're overextended and it's gone up too far, is to wait for a little pullback to one of these areas and get in on a little pullback, or wait for some quality basing like the market gave us all through this area, right? All through this area, the market gave us quality basing with a solid breakout on that candlestick right there. That's how I draw nice big arrows on a platform that doesn't let me draw big arrows. Gave me a nice big breakout trade right on this area, and it has not looked back since. So, moral of the story. Historically, the market has gone down over the last few weeks, but it's continuing to go up. Why? Don't try to overthink the markets because you're never going to know. You're never going to know where the buyers are. You're never going to know where the sellers are. But stay with the trend. If the chart is telling you to be a buyer, you be a buyer. If the chart is telling you to be a seller, be a seller. Have the humility not to try to guess the top of the market, because my guess is that you're not going to guess the top of the market. And many, many people have gone broke trying to guess the top of the market. One of my favorite quotes is that the market can stay irrational longer than you can stay solvent. The market can stay irrational longer than you can stay solvent. So learn how to read the market, especially when it comes to trend. And if you have any questions, as always, send us an email, support@TradersArmy.com. Hope you guys have a great day today. See ya.